The mortgage cliff. Whoa! Explained simply. The mortgage cliff, or as it's often called, the fixed rate cliff, is explained simply here for you. 800,000 borrowers are approaching a crucial point on their loans, and escalating mortgages are on the horizon. But how near is it? Or has the danger passed? Or is there a recession or a total property crash coming? In this episode, I've broken down all you need to know about the housing cliff into 7 simple points. You'll get the context of what has happened and the understanding of what is coming, the factors and the role that the RBA is playing, the strategies employed by banks that begun this fixed rate price wars in the first place, and finally, the direct impact on households and economic ramifications. By the time you finish watching this video, you're not only going to have a full picture, but I'm going to arm you at the end with 5 strategic countermeasures if you're in the line of fire. I'm even going to unveil my thoughts on whether I believe a property crash does or does not lie ahead. So if you like what you hear, let's get into it. But first, it'd really help out the channel if you greatly smash the like button and subscribe button so we keep you updated and informed on all the latest current affairs in the property investing realm. So, are you ready? Buckle up. Night after night, a significant concern echoes. 800,000 Australian borrowers are approaching a crucial point in their mortgages. The conclusion of the fixed rate period is imminent for numerous Australians. As the time ticks away, the looming prospect of substantially higher repayments becomes more pronounced. This phenomenon, known as the mortgage cliff, or housing cliff, or fixed rate cliff, and it holds the potential to reshape the financial landscape. To give you some context, the financial landscape for Australian households is undergoing unprecedented challenges. Escalating mortgage repayments and the most substantial cost of living pressures in 40 years are converging. The period from May 2022 to June 2023 witnessed an unprecedented surge of 4% in the cash rate, raised 11 times the rate increase not witnessed since the 1980s. Inflation, too, has also surged, reaching an apex of 8.4% in December 2022, a level unseen since the 70s. If you want to understand the fixed rate cliff, it was devised to be a type of shield, where initially a fixed rate mortgage would protect millions of homeowners during the peak of the COVID-19 pandemic. But now, this shield is on the verge of shattering. This impending crisis gives rise to pivotal questions. Could this fixed rate cliff potentially trigger a recession? Might it lead to the collapse of the property market? The Reserve Bank of Australia, entrusted with the nation's economic stability, remains watchful. The role of the RBA was quite simply counter and control this situation. The emergence of COVID-19 pandemic and even the global financial crisis has underpinned the causes. This time round, the response was unshackled from the gold standard, with governments globally resorting to unparalleled monetary stimulus. In reflection, the RBA took decisive measures, including a substantial reduction in the cash rate, the initiation of yield targeting program, and the establishment of the term funding facility. The banks also employed their strategies too. Most financial institutions strategically employed ultra-low fixed rates to entice and retain customers, culminating in intense fixed rate pricing wars. The share of the fixed rates in total home lending surged from roughly 15% to 46% by July 2021. Over $400 billion worth of real estate loans were slated in the transition into variable rates by the conclusion of 2023, thereby setting the stage for a fixed rate cliff. Here's an example of what the direct impact could look like for households. To be honest, if unprepared, the repercussions for households are palpable. Consider a scenario where which a household holds a $1 million principal and interest owner-occupied mortgage, subject to 2-year fixed period. Under this scenario, repayments would surge from $4,200 to $6,064, constituting a surge of over 40%. The economic ramifications loom large, but are surrounded by contradiction and controversy. Within the economic realm, varying predictions abound. Some economists anticipate a substantial economic slowdown, anticipating reduced retail sales and a diminished GDP. Contrary perspectives posit that households possess financial cushions and the mortgage market remains fiercely competitive. So, here is a reward for sticking around. Here are the strategies for weathering the storm, as surviving this tumultuous phase necessitates proactive measures. Alright, the 5 strategic avenues are: number 1, negotiating with the lenders. Number 2, delving into rudimentary and advanced refinancing approaches. Number 3, adopting proactive budgeting. Number 4, income enhancement strategies. And 5, adeptly addressing financial hardship. The impending jolt from all fixed rate cliffs will inevitably shape Australia's macroeconomic landscape, exerting a profound influence on the households and property values. The collective expiration of fixed rate loans, while impactful, is unlikely to single-handedly destabilise the economy or trigger a housing market crash. It is through resilience and ingenuity that these challenging times can be navigated. Before you go, if you haven't already, subscribe to our channel and stay connected. I'm loving all the questions coming through in the comments, guys. I appreciate your engagement, guys. Please await for some more enriching content in the days ahead. But in the meantime, watch this video to further improve your property investment literacy. Cheers, guys.